Wondering how ETFs can fit into your portfolio? Join us for our Spring into ETF Investing event, a 4-part YouTube series premiering on April 4th, 2025, designed specifically for DIY investors. Check out these exciting weekly events we curated specifically for you, the DIY investor. Our special guest speakers and insightful industry experts will provide the information and education you need to gain confidence and empower you to manage your portfolios. You won't want to miss these weekly specials.
Hey everybody, it's Larry Berman here, and welcome to Market Manipulation Week number 3. 4, I don't know, whatever. It seems like forever. April's been a long year. Let's dig into the chart room and see if we learned anything this week. Last bit of the day here, the market tested what we expected to be about the low end of the trading range. Recall last week we talked about 5,100 to 5,500 being the range for the next 2 months. I wasn't talking about the next few days. So we go out just above that level, which is basically where the gap was on April 2nd for the broad S&P 500. When we actually look at the Qs, here's April 2nd, this red line here, here's the high and the close. I mean, literally we're within 1% of the close and almost of the high of April 2nd pre-tariff announcement, which is mind-numbing actually, because the market just melted down, of course, in the next couple of days, followed by Trump's thought that, boy, the market's probably a good buy today on April 9th, a few hours before he actually tweeted that they were going to, delay the tariffs. And the market obviously ripped on that. Everyone will remember a lot of backing and filling. And that's really what this market is about. Now, I have to ask the logical question. Are we past this, or is this just the beginning? And I would argue that this is just the beginning with a lot more to come, and that the volatility isn't gone away, and you shouldn't think that the low is in for good, and we're not going to get, an economic slowdown or recession. Torsten Slok, chief economist at Apollo Global, put out a piece this week or over the last week, and talked about, empty shelves and I guess all the things that prompted Trump to flip this week in terms of some of his more aggressive commentary on tariffs and everything else. And that they're getting close to deals and things. So again, I think we're just beginning. I think there's some economic hardship to come, but we have yet to see it because it's way too early still in terms of what's happening. Now, Fed had their beige book this week, and in the beige book, we heard from all the Federal Reserve regional banks, the setup for the next meeting in 2 weeks, and a little less than 2 weeks now. Fed's in blackout, and we basically heard that a cut is possible if we see the economic decay, if the data, suggests. So, with the market sort of back up towards the pre-April 2nd levels, there's no rate cut coming. So I think you have to make a strong argument that the market can't break out here, and if it does, what's causing it? Because when you look at it, and you look at from an earnings perspective, so trailing earnings 2024 in the bank 245. 2025 earnings expectations, they've started to come down this year, as you could see, have been for a little bit, 265. That is still expecting 8% earnings growth in a world where the U.S. economy will probably struggle to have 1% GDP this year. Okay, now, and we can debate that if you like, but it's a low growth outcome this year for sure, with all the headwinds of tariffs and every other little bit of uncertainty that's caused in the C-suite. If you look at 2026 earnings, was $300. And if you think about what that multiple is compared to where the market is today, you kind of say, okay, that's not too bad looking out if those are the earnings. But if we go into a recession, that number is not the number. Like we're going to have at best a flat earnings year, which makes the market at 5,500 22 times, trailing earnings. If you think about forward earnings, at 265, it's 20 times earnings. So there's a lot of narrative around, is the U.S. exceptionalism still there? And is that changing? Is money leaving the U.S. and going to other places in the world? And there's definitely some of that. A lot of that, part of that may have been unwound. So you have a couple elements at work here. Market leverage being, increased and decreased. You have money moving from, this region to this region, impacting currencies. When we look at the bond market, TLT, the long end of the curve, year to date up slightly, but, was starting to price in a harder economic landing. And then you got the worry about firing Jerome Powell. I was never going to fire Jerome Powell. Are you kidding me? No. I think he's behind the curve. I think he should be cutting rates, but no, fire him? No. Well, anyways, I watched The Apprentice movie this week, just out of pure circumstance. I was flipping through channels looking for a movie to watch the other night, and there it was, and I'm like, oh, I gotta watch this. And so of course that was the story of Trump in the 70s and 80s around, how he's developed and his style and his interest in politics and his interaction with Roy Cohn, who was that lawyer that seemed to teach Trump how to screw people. I don't know how to negotiate, however you want to phrase it. And it was just very eye-opening. Not that I didn't know some of that already. Remembering that I was one of the early readers of Art of the Deal. I was a big fan for many years, not knowing the true, Donald Trump in that sense of, so he's the kind of guy who's, when he's on your team, you want him on your team because he's a tough negotiator, right? And you don't want to face him because he's a tough negotiator. But again, for me, for style points, 2 thumbs down. In any case, expect more volatility, I think is the messaging here for the most part. When we're looking at the rally Friday up to the 5,500 level and looking at market breadth, was decidedly negative. S&P 500, 296 down, 205 up. For the NASDAQ, a little bit more balanced. This is where tech and AI names were leading. Plus, you got a tremendous amount of short covering. The stocks that moved the most on the week were the names that had the highest short open interest. Not all of them, but in general. So the rally this week reeked of some short covering, was supported by Google's earnings. This week we get the rest of Mag 7, X Nvidia, which is still a couple of weeks down the road. And after this week, if we're still north of 5,500 on the S&P 500 and, at this level or higher than the April 2nd level on the Qs, you really got to say, what is the market thinking? market must be thinking this is all in the rearview mirror and we've got clear sailing ahead, and let's ramp up the multiple here. Okay, so to me, that's a scenario where I just kind of go one of those. Anyways, last on the chart list this week is gold relative to gold equities. And the ratio at the bottom here is GLD divided by GDX, and so in normalized terms. So going back 5 years at an equal ratio of 1, current ratio of 130, gold has outperformed gold equities by 30%. But on a year-to-date basis, where this ratio is at 150, gold equities have started to perform. So you definitely are in the buy the dips mode, but on the recent peak, if the broader equity market is going to be sustained, then gold's probably going to lose some of its luster here. I'm not sure that that's going to play out, so I think we're still in a buy dips mode. But in the short run, both gold bullion and gold equities got a little blow off top going and probably need some backing and filling. Put those on your front burner radar to buy into some weakness here, because clearly I think there's a lot more volatility to come. And I actually like silver, big picture for the next number of years over gold at this point. So if you look at the gold silver ratio, and I'll throw that into the charts here very quickly so that you can see that over the last 5 years. Gold's pretty significantly higher relative to silver. Last time we saw silver stronger than gold was, back in COVID. And so there's a lot more potential here for silver, I think. And I like names like Hecla, for example, as a buy on dips if you're looking for individual names. There, First Majestic is another one we're playing. We've got 2 big positions in. So I'm liking those. Expect them to be very, very choppy and volatile. Don't favor the breakout kind of trade. Favor the buy the pullback trade to get involved in the precious metals here. Anyways, have a great week, everyone.